Assalamualaikum warahmatullahi wabarakatuh. My name is Hanif Hamzah bin HAMIZAN from M3822068. Today, I will present the company financial ratio analysis between Dash Lady and FNN Company. As for introduction, the Dash Lady Company was founded in 1963 at Petaling Jaya, Selangor. They employs a total of 600 employees that focus on producing milk-based dairy products such as formulated milk powder, yogurt, milk, UHT, and marketed across Malaysia. On the other hand, the Fraser and Neave or FNN was formed in 1883 in Singapore. Nowadays, this company already operating in Malaysia, Brunei, Thailand, and Indochina with a total of 2,500 employees. This company focuses on food and beverages products such as soft drink and dairy product. Next, we will move to the trend analysis for Dash Lady. In this table, this is the summary of trend analysis for Dash Lady for 3 years. Okay, first, we will start with the current ratio. Based on the bar chart, the performance of current ratio for this company is decreasing from 2019 to 2020. However, it is increasing on the next year and become the highest between these 3 years. This shows that the company is good in paying their short-term obligation. Next is quick ratio. Based on the bar chart, we can see the company performance is decreasing from 2019 to 2020. Not only that, both of these years are considered as underperformance since the quick ratio is below than 1. However, the highest quick ratio was recorded in 2021. This means that the company is able to meet their short-term obligation in future. The next ratio is the inventory turnover. Obviously, we can see the inventory turnover for the company in 2019 and 2020 is good since there is an increasing of performance. This shows that the company is efficient to manage their inventory to generate sales. However, the lowest inventory turnover was recorded in 2021. This shows that the company is less efficient in managing its inventory to generate sales as compared to the previous years. Meanwhile, as for the total asset turnover, we can see the performance of company is decreasing from year to year. This shows that the Dash Lady company is less efficient to manage its asset to generate sales. Okay, then we move to the next ratio, which is debt ratio. Based on the data, we can see the company performance is increasing every year because the debt ratio is keep on decreasing until it reached below 50% on the latest year. This indicates that the company is good in managing their debt and may face low financial risk. As for the debt to equity ratio, we can see that the company performance is increasing every year, but unfortunately, the performance is still not good because the debt to equity ratio is more than 50%. This shows that the company is getting more of its financing by borrowing money, which is dangerous if the debt level are too high. Next, we move to the gross profit margin. Based on the bar chart, we can see the performance of company is decreasing in 2020 and increase in 2021. However, the gross profit of this company for 3 years still considered as underperformance since it is below than 50%. This indicates that the company is not able to earn more per ringgit and maximize shareholder wealth. As for net profit margin, we can see that the company performance is decreasing in 2020 and increasing with the highest net profit margin in 2021. This shows that the company is able to earn more per ringgit and maximize shareholder wealth as compared to the previous years. However, the company is still considered as underperformance since the net profit margin is below than 50%. Okay, now we move to the next company, which is FNN. This table shows the summary of trend analysis for 3 years for FNN company. Okay, let's start with liquidity ratio. Based on the bar chart, we can see that the performance of company for current ratio and quick ratio is increasing every year. This indicates that the FNN company is good in paying their short-term obligation and able to meet their short-term obligation in future. Meanwhile, for inventory turnover and total asset turnover, we can see the company performance is decreasing in 2020. This indicates that the company is not efficient in managing their inventory and assets to generate sales. However, it is different on the next year where the company able to increase their performance. This shows that the company is good to manage their inventory and assets to generate sales as compared to the previous year, which is 2020. Now, we move to the leverage ratio. First, for the debt ratio, we can see the company performance is increasing every year when the debt ratio is decreasing below 50%. The overall performance for company is good when the debt ratio is below 50%. This indicates that the company is good in managing their debt and may face low financial risk. This also same for debt to equity ratio when the company performance is increasing every year when the ratio is keep on decreasing. The overall performance of debt to equity ratio for 3 years is good when all of it below 50%. This shows that the company is getting a lower amount of financing by debt via lenders as compared with the funding through equity via shareholders. And lastly, we will cover the profitability ratio for F&N company. For the gross profit margin, the company shows a bad performance since the gross profit margin decreasing every year. Not only that, the overall performance for gross profit margin is bad since all of it below 50%. This shows that the company is not able to earn more per ringgit and maximize shareholder wealth. Meanwhile, it is different for net profit margin, where the performance of company is increasing in 2020, but in 2021, it dropped to the lowest net profit margin among 3 years. This shows that the F&N company is having a problem to earn more per ringgit and maximize shareholder wealth. Not only that, the overall performance for net profit margin is bad since all of it recorded below 50%. Okay, now we proceed to the next part, which is the cross-sectional analysis. In this analysis, we will compare all ratios for the latest year between Dash Lady and F&N company. Based on the table, this is the summary of cross-sectional analysis for both company. First, we move to the liquidity ratio. For the current ratio and quick ratio, the F&N company is more better than Dash Lady company. This shows that the F&N company is good in paying their short-term obligation and able to meet their short-term obligation in future as compared to Dash Lady company. Then, we will move to the activity ratio. Based on the table above, we can see that the Dash Lady company is better than F&N company in terms of inventory turnover and total asset turnover. This shows that the Dash Lady company is good in managing their inventory and assets to generate sales as compared to the F&N company. However, both companies still shows a good performance since the ratio is more than 1. Next, we will proceed to the leverage ratio. As for the debt ratio, we can see that the F&N company is better since it has a lower debt ratio than Dash Lady company. This shows that the F&N company is good in managing their debt and may face low financial risk as compared to Dash Lady company. However, both companies still shows a good performance when the debt ratio is below than 50%. Meanwhile, as for the debt to equity ratio, F&N company is better since it has lower ratio than Dash Lady company. This indicates that the F&N company is getting a lower amount of financing by debt via lenders as compared with funding through equity via shareholders. However, since the debt to equity ratio for Dash Lady is more than 50%, the company is getting more of its financing by borrowing money, which is dangerous if the debt levels is too high. Lastly, we will move to the profitability ratio. For the both gross profit margin and net profit margin, the Dash Lady company is better than the F&N company. This shows that the Dash Lady company earn more per ringgit and able to maximize shareholder wealth as compared to the F&N company. However, both companies still considered as underperformance since the gross profit margin and net profit margin is less than 50%. Now we proceed to the conclusion. We start first with Dash Lady company. Based on overall performance, we obviously can see that the company is good in terms of liquidity and activity ratio. This indicates that the company is able to meet their current obligation and able to manage their assets to generate sales. In addition, the debt ratio also shows a good performance, but it is different for debt to equity ratio. This indicates that the company still have their remaining debt. Not only that, the profitability ratio also shows a poor performance when both gross and net profit margin is below 50%. Therefore, the company is not able to gain more profit. As for the F&N company, we can state that the overall performance in terms of liquidity, activity and leverage ratio is very good. This shows that the company is able to meet their current obligation, manage their assets to generate sales and able to manage their debt. However, it is different for profitability ratio when it shows a poor performance when gross and net profit margin is below than 50%. This indicates that the company is not able to gain more profit. Now we move to the recommendation. First is the total asset turnover, especially for Dutch lady company. Firstly, the company can improve their total asset turnover by increase their revenue by selling more product, using marketing, promotion and many more. Next, the company also can improve the account receivable collection, where they should reduce the amount of time for customer to pay. And the last one is to have a good inventory management. When the inventory management is good, the product can be delivered to customer efficiently and improve the sales as well. Next, we move to the inventory turnover, especially for Dutch lady company. Firstly, they can improve their revenue by using any marketing strategies to promote the less demand product to gain more sales volume. Second, the company can eliminate the less demand product and produce a new product based on the latest needs and wants of customer. This can help to reduce the leftover stock. Third is to improve the inventory management. And lastly, the company should restock based on the demand. This is to prevent from excess cost of restocking and product expiration. Okay, then we proceed to debt to equity ratio that focus more on Dutch lady company. First, the company can improve their sales and at the same time try to minimize the cost. The extra cash generated can be used to pay the debt. Next, the company also can improve the inventory management as well. And the last one is they can refinance their existing debt based on the current interest rates. If the current interest rates is lower, then it will be more better. Next is the gross profit margin, especially for both company. Firstly, they can increase sales revenue by selling more product. Second, they also can increase selling price, so they will gain more profit. Third, they also can reduce the cost of goods sold by negotiate with supplier for more discount, find new supplier that offer lower price with high quality and many more. This will help company to gain more sales volume without lowering the selling price. And the last one is the net profit margin. This recommendation is for both company. First of all, the company can increase the revenue by increasing the selling price to gain more profit, or reduce the selling price to gain more sales volume and finish the stock. Second, they also can reduce labor cost by reducing working hours by reschedule the workers so they do not need overtime anymore. And lastly, the company also can reduce the inventory cost by negotiate for more discount, find new supplier with lower price and many more. That's all from me. Thank you.